The picture I'm about to paint is not pretty, but let's be honest, it's time for Canadians to stop burying their heads in the sand and start to pay attention. I'm going to explain today's Bank of Canada rate decision, but I'm also going to give you three reasons why this is all just bad comedy, bad theater. Amid economic uncertainty, the lower risk of inflation and trade wars still looming, the Bank of Canada has decided to lower its key overnight rate to 2.5%. That's a drop of 0.25% this morning. The general consensus by most economists were looking at this rate drop this morning of this quarter point. It was widely regarded, given the economic circumstances, that the Bank of Canada would make this exact move. However, there's some other data that I don't think Tiff Macklem and the rest of the chair committee at the Bank of Canada is really considering. And here's some of that economic data that should bother most Canadians. Canada's national unemployment rate is up to 7.1%. And in August, it lost 66,000 jobs. And Ontario's manufacturing sector lost over 30,000 jobs in Q2 of 2025. Ontario's unemployment rate remains stubbornly high at 8%, with Toronto being over 9%. And youth unemployment reached 14.6% in July of this year. All this while the retail and service sector seems to be gung-ho about the temporary foreign worker service, hiring foreign workers to replace people who aren't able to find jobs. In other economic data, housing starts, although they're up 4%, are still extremely low and not providing the housing that's required for most Canadians. Economic growth, that is GDP per capita, has been flat throughout 2025. Exports nationally are down 7.5%, and machinery and equipment investment is down 9.4% since the beginning of the year. The most concerning statistic, however, is that of capital that is being divested from Canada and going overseas. Foreign investors divested $16.8 billion of Canadian securities. That makes the cumulative foreign divestment in Canada at almost $23 billion in this year. The net portfolio outflow of Canada was almost $44 billion in Q2 of 2025 alone. That's equivalent to the federal government's entire infrastructure budget for 2024. This outflow of capital suggests a loss of confidence in Canada's economy, in employment, and prospects to earn a return on their money. Foreign direct investment, called FDI, has dropped significantly in Canada, a fall of 39%, indicating a decline of interest in investing by foreign investors. We know in physics that nature abhors a vacuum, and this capital vacuum that's being sucked out of Canada is likely going to lead to the government massive debts coming in the budget, which is now being tabled on November 4th of this year. Meanwhile, in the US, the Federal Reserve has indicated that rising unemployment may be a more persistent and more dangerous consideration in their decision later today than higher consumer spending. Notwithstanding the economic factors, Fed Chair Jerome Powell is also facing political pressure from Washington to ease the burden on debt-laden consumers. U.S. inflation has remained higher than the expected and proposed 2% standard of inflation. They will be releasing their numbers at 2 p.m. Eastern later today. Having said all this, it's my opinion that the Bank of Canada and the U.S. Federal Reserve are focusing on the wrong things. Here's those three economic points that I was referring to earlier. Number one, they're focusing on price increase rather than real economic growth. They're focused more on the consumer price index than the growth of the GDP. As mentioned earlier, Canada's GDP is flat all year and should indicate a reduction of rates if that's what they were focusing on. Number two, they're interfering in the market. They're manipulating the price of money. They're hoping that the change of the cost of dollars will change the trajectory of the economy, but without any guarantees to do so. They're only acting on hope. And number three, they're changing the reserves of the commercial banks who are complicit in this game of inflation. Remember that inflation doesn't mean that prices are rising because goods are becoming more valuable. Inflation is a measure of the devaluation of dollars and their exchange on the market. At the end of the day, none of these headlines really matter unless Canadians are going to demand better stewardship of the money and the governance of the money of this country. Rate cuts and glossy press releases don't create prosperity. Productive work, investment, and sound money do. Until a leadership of this country stops fiddling around with the value of money and gets out of the way of the private market and free enterprise, we are just going to continue to spin our wheels. So stay informed, question the narrative of the Bank of Canada in Ottawa, and don't let them convince you that it has to be this way. If you found this interest rate breakdown of the Bank of Canada's decision helpful in any way, make sure you like, subscribe, and share it with other concerned Canadians. The more of us who understand what's at stake, the more likely that bad policy will be unable to hide behind fancy jargon and rhetoric.